Welcome to StokTok's deep dive into Bank of China Ltd. Bank of China is one of the largest financial institutions in mainland China, operating as a systemically important bank with a dominant presence in both retail and wholesale banking, wealth management, and international trade finance. The company serves hundreds of millions of customers across China and maintains a global footprint through branches and subsidiaries in dozens of countries. As of May 8th, the stock is trading at $16.27, positioned near its 52-week high of $16.93, which reflects relative stability at the upper end of its recent trading range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Bank of China generates revenue through three primary channels: net interest income from lending and deposit-taking operations, which represents the bulk of banking revenues; fee and commission income from wealth management, investment banking, and payment services; and trading and investment gains from proprietary securities and foreign exchange activities. The company's competitive moat rests on three pillars. First, its status as a state-owned, systemically important bank grants it implicit government backing and preferential regulatory treatment. Second, it maintains an extensive branch network and digital platform that creates switching costs for retail depositors and borrowers. Third, its position as a gateway to Chinese capital markets gives it pricing power in international trade finance and foreign exchange services. The StokTok score for Bank of China is 41 out of 100, signaling caution. Breaking this down, valuation scores 20 out of 20, indicating the stock is trading at an attractive multiple. Financial health scores 7 out of 20, suggesting material balance sheet concerns. Profitability scores 10 out of 20, reflecting thin margins relative to capital deployed. Growth scores 4 out of 20, pointing to anemic revenue expansion. Smart money scores 0 out of 20, showing no institutional accumulation. Now, valuation. The question every investor has to answer: are you paying the right price? Bank of China trades at a price-to-earnings multiple of 6.21 times trailing 12 months earnings and a forward price-to-earnings multiple of 5.96 times. These are deeply depressed multiples. The market is pricing in sustained earnings pressure and little to no growth. The PEG ratio, which divides the price-to-earnings multiple by expected growth rate, stands at 0.79. A reading below 1 typically signals that valuation may be attractive relative to growth prospects, though in this case the growth rate itself is so minimal that this ratio offers limited reassurance. The enterprise value to EBITDA multiple shows 0.00, which reflects the peculiar accounting treatment of certain banking assets and the dominance of net interest margins over operational EBITDA. Here is the key point. Our DCF model suggests the stock is trading at a 46% discount to intrinsic value. That is a material margin of safety. The market is currently pricing in significant headwinds: slowing loan growth, margin compression from lower policy rates, and competitive pressure from digital fintech competitors. Our analysis indicates a fair value range between $23 and $27 per share, representing potential upside of approximately 40 to 65% from current levels. This assumes the regulatory environment remains supportive and loan growth stabilizes. Regarding the most recent earnings results, Bank of China reported trailing 12 months revenue of $178.72 billion, growing at 7.1% year-over-year, which slightly missed consensus expectations of $566.97 billion in quarterly revenue estimates. Net income reached $56.63 billion, underscoring the bank's profitability in absolute terms even as return on equity remains constrained. Market sentiment around Bank of China leans neutral, with some positive signals from earnings revisions offset by concerns about geopolitical tensions and weak domestic market conditions. The next earnings report is scheduled for April 29, 2026, which will provide critical updates on credit quality and capital adequacy. From a peer perspective, Chinese state-owned banks historically trade at price-to-earnings multiples between 6 and 8 times in bull markets and between 3 and 5 times during credit stress periods. At current levels, Bank of China sits squarely in the lower end of this range, suggesting valuation is not the primary constraint on the stock. Moving to financial strength, how solid is the foundation? This is where the thesis faces real headwinds. Bank of China's Piotroski F-score, a 9-point checklist that grades accounting health and balance sheet quality, stands at 4 out of 9. A score above 5 signals financial strength. Below 5 raises red flags. A score of 4 suggests deteriorating asset quality, potential margin pressure, or changing working capital dynamics. The Altman Z score, which predicts bankruptcy risk by combining profitability, liquidity, leverage, and market metrics, shows 0.00. This is a distress signal. For context, a Z-score above 2.99 indicates low bankruptcy risk. Between 1.81 and 2.99 represents a gray zone, and below 1.81 signals potential distress. Bank of China's reading of 0 is anomalous and likely reflects the unusual accounting treatment of banking assets and the fact that the model was designed for manufacturing companies, not financial institutions. More relevant to credit analysis, the bank's cash-to-debt ratio stands at 1.61, meaning it holds $1.61 of cash equivalents for every dollar of debt obligations. That is reasonable. However, the debt-to-equity ratio of 0.83 indicates the bank is carrying leverage approaching 1-to-1, which is manageable but constrains flexibility during stress periods. Current ratio data is unavailable, which limits visibility into short-term liquidity. Interest coverage ratio is unavailable, but given the bank's net interest margin compression, the spread it earns between borrowing and lending rates, this is a concern. The regulatory capital adequacy requirements for Chinese systemically important banks are stricter than for smaller peers, and any deterioration in loan portfolio quality could force the bank to raise equity or cut dividends. Overall assessment: the balance sheet is not in crisis, but it is tightening, and there is limited room for loan growth without capital raises. Next up, profitability. Is this business actually making money efficiently? The headline number is striking. Net margin stands at 36.54%, meaning that 36 cents of every dollar in revenue drops to the bottom line as net income. That is exceptional profitability on the surface. However, this figure must be interpreted in the context of banking. High net margins are the norm in financial services because gross margins and operating margins are not applicable accounting concepts. Banks do not have cost of goods sold or traditional operating expenses in the manufacturing sense. Instead, the relevant metric for banks is return on invested capital, or return on invested capital, which measures how much profit the bank generates on each dollar of shareholder equity and retained earnings deployed. Bank of China's return on invested capital is 0.00, which is deeply problematic. A return on invested capital near zero means the bank is essentially returning 0 cents on every dollar of capital shareholders have invested, implying no economic value creation above the cost of capital. This is a core reason why the stock trades at such a depressed multiple. Gross margin and operating margin figures of 0.00 reflect the accounting treatment of net interest income in banking. These metrics are not meaningful for evaluating bank profitability. The free cash flow margin, however, stands at 148.24%, suggesting the bank converts net income to actual cash at a high rate, which is typical for financial institutions with low capital expenditure requirements. Return on equity, a key metric for banks, is 8.14%, and return on assets is 0.65%. These are weak relative to global banking peers, which typically report 10 to 15% ROE. The most recent quarter reinforced this profitability constraint. The bank earned $56.63 billion in net income on $178.72 billion in revenue, but this was achieved on an enormous asset base, and the incremental returns on marginal assets appear to be declining. The core issue: net interest margin compression from lower policy rates and competitive pressure, is squeezing the primary source of bank income, and fee income growth is not offsetting that decline. Onto growth, is this business expanding and at what rate? This is the primary bear case for Bank of China. Revenue growth over the trailing 3 years averaged 4% annually, and growth over the trailing 5 years averaged just 2% per year. That is essentially stagnant. For context, the global financial services sector has historically grown 4 to 6% annually in nominal terms. Bank of China is growing at half that rate or less. The most recent quarter showed revenue growth of 7.1% year-over-year, which represents a modest acceleration from the 5-year trend. But this is likely a statistical bounce rather than a sustainable inflection. Management guidance has not signaled an acceleration in loan growth, and the headwinds are structural. China's economy is slowing, credit demand is weakening, and policy rates remain low, further pressuring net interest margins. Book value, which represents the net equity on the bank's balance sheet, has grown at 5.5% annually over the trailing 3 years, which is marginally better than revenue growth. This suggests the bank is at least growing its capital base through retained earnings, though the return on that incremental capital remains questionable. The dividend yield stands at 5.03%, which is attractive and provides income support for the stock. However, the sustainability of that dividend is contingent on the bank maintaining current earnings levels or growing them. If loan growth continues to decelerate or loan loss provisions increase materially, dividend coverage could become strained. In our view, the growth outlook for Bank of China is challenged. The stock is best characterized as a mature, dividend-yielding financial institution in a low-growth environment, not a capital appreciation story. Now let's talk smart money. What institutional capital is actually doing with this name? Here is where the red flag becomes a blinking alarm. Bank of China currently has 0 top-tier investors or gurus holding positions in the stock, according to our database of hedge fund and family office positions. 0. This is remarkable. It indicates that the most sophisticated, long-term oriented capital in the world has no meaningful conviction in this name. Across all 13 F filings, the quarterly disclosure forms that institutional money managers must file with the SEC, 0% of institutional filers show net bullish positioning, meaning more than 50% of holdings. This tells us that institutions collectively are neutral to net sellers, not net buyers. Insider ownership by management and board members stands at 0.0%, which is exceptionally low. Management owns virtually no stock themselves, creating a misalignment of interests with shareholders. This is a common feature in state-owned enterprises where political appointees manage the company, but it is a red flag for minority shareholders. Over the trailing 3 months, there have been 0 insider buys and 0 insider sells, indicating no meaningful activity by those closest to the business. The absence of insider buying during a period when the stock is trading at a discount to intrinsic value is telling. It suggests that management does not believe in the value proposition, or they are restricted from trading by regulatory rules. Either way, the smart money vote is clear. Bank of China is not viewed as a compelling investment opportunity by the institutions that deploy capital globally. This does not necessarily mean the stock cannot outperform, but it means investors are proceeding without validation from the professional community. And finally, the verdict. Let's bring it all together. On valuation, Bank of China trades at a significant discount to intrinsic value, with our analysis suggesting a fair value range between $23 and $27 per share, representing upside of approximately 40 to 65% from current levels. The 6.21 times price-to-earnings multiple is deeply depressed relative to historical norms. On financial strength, the balance sheet is adequate but tightening, with concerning profitability metrics on capital and limited financial flexibility. The Piotroski score of 4 out of 9 and the leverage profile warrant caution. On profitability, while net margins are mathematically high at 36%, the return on invested capital of 0% reveals that the bank is destroying shareholder value on marginal deployments of capital. This is the core problem. On growth, Revenue expansion of 4% over 3 years and 2% over 5 years is stagnant. The bank is not growing the top line materially, and profitability growth is constrained by margin compression. On smart money, zero institutional guru holders, 0% net bullish positioning among large institutional filers, and 0% insider ownership all signal that professional capital has zero conviction in this name. The most recent earnings confirm the thesis. $56.63 billion in net income demonstrates absolute profitability, but the 7.1% revenue growth and stable margins suggest no inflection toward acceleration. Bank of China is a mature, dividend-yielding financial institution trading at a cheap multiple because the market is pricing in continued margin compression and stagnant growth. The valuation offers a margin of safety, but that safety premium exists for a reason. The company is not expected to generate significant shareholder returns above the dividend yield. For income-focused investors with a long-term horizon and comfort with geopolitical risk, the stock warrants consideration. For growth investors, this is likely not the right vehicle. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Bank of China Ltd. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.